There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We're going to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for an exclusive trading education event. Sign up now.
Stock futures are slightly up this morning as new jobless claims figures provide more clues about our economy. Major players in the market release earnings today, including Google, Microsoft, and Morgan Stanley. I'm Brittany Umar, and the morning call starts right now.
Good morning, everyone. I'm T3 Live Editor-in-Chief John Darsie.
And I'm Brittany Umar, and together we bring you Morning Call. So as we said, their futures are higher this morning after a rise in European markets. And now the question is this a bounce we should be looking to short based on all the faulty signals we've been seeing?
I think so. I think we've seen what I talked about in the headline yesterday for the daily recap was that we've seen violently indecisive action. And what that means is that we haven't been going much of anywhere yet. We haven't got that deep correction, but what we are seeing is a lot more volatility and a lot more erratic behavior and some relative weakness in some key sectors.
So before we get into the faulty signals we've been seeing in some of those sectors, show us what levels you're watching in the S&P as we head into today.
Yeah, so we're up slightly this morning, like Brittany said. It's nothing huge, so I think it'll be interesting to keep an eye on the short-term reference points that are yesterday's high and low in the S&P. So if we take a look at the spider chart here, we'll go to the 5-minute to see where futures are this morning. So we're 155.67 is the last print in the pre-market. We go back to the daily chart. We look at yesterday's candle. The high is 156.32. So on a short-term basis, that's what traders look at to see if we can reclaim yesterday's losses. And then we also have the 8 and 21-day moving averages starting to curl down near that area, as you see here. So that'll be a very important level that people will be watching closely.
Well, let's talk about some of those faulty signals and the reasons why this pullback that we have been seeing could be a little bit different, even despite futures being higher this morning. We have seen the TLT, the Treasury Bond ETF, in a steady uptrend, which is a little unsettling for equity investors while the market is at highs as a sign of flight to safety.
Yeah, I think in general you've had all these headlines in the last couple of years about the possible great rotation into equities, and I think it's become such a popular narrative that a lot of times when you have everybody believing the same thing, it doesn't happen. It's just not the way the stock market works. That's not the way any markets work, is that they don't make it easy for anyone, and we haven't seen that rotation out of bonds. I think people are still jittery from the financial crisis in terms of piling into risk assets, especially at all-time highs. They don't want to be the lamb before the slaughter, but if you take a look at the TLT, we had on that jobs report Friday, we had a big gap up, and I stood here on the daily recap on that jobs report Friday because of that huge move in the TLT, the Treasury Bond ETF, and I said, I don't know when it's going to happen. It's impossible to time a short in this market that's been trending higher for the whole year, but I believe this market is going lower, and although we did fill that gap in the TLT, it bounced off of its 200-day moving average and is back up to those levels. So I think it's very important to note this action in the TLT, which is usually inverse to the market. I think the market has tried to shrug off some of the strength in the TLT and tried to ignore the fact that money is still rotating into bonds, which have historically low yields. But I think it's another example, like you said, of that flight to safety and the fact that people are not sold on jumping back into the stock market in a lot of size.
Right, that was a nice call there. Another big faulty signal that we've been seeing is the extreme weakness in gold. We are seeing a bounce in commodities though this morning in gold and oil. Gold's up about almost 2% at last check. But would you say this is a buying opportunity, or do you think that this is just the beginning of another really big correction in gold? Yeah,
we talked about relative weakness in a lot of sectors, and then in addition to that on Friday and then Monday it accelerated, but when you have severe dislocation in commodities markets like we saw with gold, had its biggest drop in 30 years, that's not a healthy sign for the market. I know, gold is not part of the S&P 500 or anything like that. It's an ETF that tracks a commodity, and commodities are inherently volatile. And so I think you have to understand that. And people sometimes try to trade the GLD like a stock, and it's an ETF first of all, but it doesn't behave like stocks because gold is completely based on supply and demand. It doesn't really have any industrial value or it doesn't do anything for you in terms of producing things. So that's Warren Buffett talks a lot about that, about how gold is risky because at the end of the day, it's not crops or it's not Procter & Gamble that produces goods. It's really just completely an idea. And we had a huge drop off in gold. And this morning, like Brittany said, it's 2% higher. And gold bugs will be telling you that this is an amazing buy opportunity in gold. But I think a lot more people right now will probably tell you that gold seems to be headed lower based on the extreme action that we saw late last week and early this week. Whenever you see a huge move like we've seen, it usually leads to lower prices. And it's not something that you buy immediately after a huge price drop.
Well, we've also continuously highlighted the transports and the weakness there as clues that the market could lead us lower. And right now we continue to see weakness there despite lower oil prices.
Yeah, I mean, you've had oil prices going down with the precious metals, but you still haven't seen the transports be able to bounce. And the transports are seen as a leading indicator for the market. It's a sector that when the transports are leading the market, people see that as a sign that the stock market has more upside. And that's what we were seeing for a little while there, but then we've seen a big change in that regard, and the transports are showing extreme relative weakness. If we go to the IYT on the chart, you can see almost a head and shoulders pattern that we've been talking about is formed in some of these sectors that have been showing relative weakness, and we're right at that neckline. The market's up a little bit this morning, but it'll be interesting to see what happens if we do break that rising neckline. And I think the measured move down to the 200-day moving average would make a lot of sense based on the pattern. So I think the IYT is definitely one of those huge red flags we've been talking about and continues to be a concern for me as far as the broader markets go.
Well, buying of call options for the VIX just hit a 3-year high, implying a belief it will go higher, which is usually an ominous sign for stocks. So with the expectation that the market is likely to remain more volatile, what's a trader to keep in mind?
Yeah, I mean, I think the VIX are evidence that there's still fear and stuff like that after the financial crisis and at highs. People are more inclined to buy protection rather than pile into the stock market. But I think the VIX is a little bit of a lagging indicator, and I think you pay more attention to signs that we've been talking about with sectors that are weak and with extreme dislocation in commodities markets, and those are type of things that give you clues about a potential correction before it happens. And the VIX ticking up is also evidence of that fear and selling, but it's a flawed ETF, first of all, the VXX, and it's not something that I would play directly, but something to take note of for sure.
All right, well, coming up, we're going to go in the trenches with the banks after their earnings reports, including Morgan Stanley just reporting this morning. But first, a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and going in the trenches with the banks after their earnings reports. After many came out with solid reports but sold off since, including JP Morgan and Wells Fargo, which have been out of play since their decent earnings reports. Yeah,
I mean, in general, you've seen a lot of reports from the banks that beat consensus expectations, which are set by sell-side analysts. And I don't put a lot of stock in those. The real numbers that you need to look at are whisper numbers and numbers that traders and investors are expecting on the buy side. There's actually an interesting website or app, whatever you want to call it, called Estimize, that focuses more on the buy-side analysts' expectations for earnings. And I saw an article yesterday. Lee Drogan is the founder of this company, and it got picked up on Bloomberg terminals. So it just tells you that more people are starting to look at these whisper numbers, and that's what you really need to pay attention to rather than going to Cap IQ or going to Briefing or going to whatever service you have and looking at the supposed consensus estimates. But we've seen these banks come up with what looked like solid reports, but almost all of them have traded lower.
So could you show us a visual then of JP Morgan and Wells Fargo, show us the levels that you're watching since? Yeah, JP Morgan is one that has been weak in general. You've had all the London whale issues, and it's sort of been trying to work through some of that sludge. But yesterday you saw extreme selling in the sector, and especially in JP Morgan.
and it's coming into that upper level pivot here that, based on the extreme move we saw yesterday, I think this pivot is going to break, and I think you could see JP Morgan back into its 200-day moving average at some point. I think the banks in general could be a sector that lead us lower, and JP Morgan could be one that shows relative weakness in that sector. Wells Fargo is one that's a more risk-averse bank and is less volatile as a result of that. So if you're trying to put money to work long-term, if you just made your 2012 IRA contribution before the tax deadline, then and you're looking to get some exposure to the financial sector, I like Wells Fargo. It has a nice dividend yield. It's above its 50-day moving average. Technically, it looks better than a lot of the other banks, but like I said, I think the sector in general could be due for a little bit of a pullback. It'll be interesting to see where that goes for Wells Fargo.
Well, checking in on Goldman, which reported on Tuesday what looked like solid results and then also traded lower, was sold off right on the open. It has since breached its 100-day. So do you think we are set for even lower prices for Goldman as well?
I mean, Goldman's another one that had a very strong report, it seemed. It handily beat consensus estimates, that word I keep throwing around, but the street didn't seem to like it, and it didn't break back above this descending channel, and it broke this pattern to the downside. It broke this pivot. It was able to bounce off of its lows into the close yesterday, but it'll be very interesting to see whether that pivot is able to hold today. The market's up a little bit, so everybody will be looking at yesterday's close and yesterday's lows and highs as their short-term points of reference, and you see these moving averages starting to curl down for Goldman. You have the 8 and 21-day curling down, and you have the 100-day starting to curl down, and this is one that it has been the leader this year and since December in the sector. But I think Goldman could be another one that shows relative weakness even in the banks.
And even Bank of America yesterday had a decent overall report, but results fell short of expectations. Stock sold off 5%. So
it's sort of like Goldman Sachs' Bank of America. It had one of the weaker reports among the group. It didn't have a very it didn't handily beat estimates the way Goldman Sachs did. But if you look at a chart of Bank of America, it had an extreme down move yesterday. It also was able to close off of its lows, but was down around 4.7%. It's a similar pattern in a lot of these bank stocks. As you have this pivot that's from that jobs report day when the markets gapped lower but were able to bounce. You have that pivot that is trying to hold, and then in Bank of America you have another upper level floor, and I think we'll try to test that upper level floor, and then if we do break it, the 200-day moving average looks like, to me, based on just a glance at these charts, looks like a spot where the banks could fall back into and potentially lead this market lower based on that bearish thesis.
Yeah, at this point it seems like it would take a lot for the banks to impress traders. Even Morgan Stanley reporting this morning beat profit estimates, but the stock is trading lower, just like such was the case with many of its peers.
Yep, hate to be redundant, but Morgan Stanley this morning. We'll take a look at the 5-minute chart just to see an idea of the pre-market action. It's not terribly lower, but it did handily beat EPS. I believe it was 61 cents it earned versus expectations of 56 cents. We go back to the daily chart. It's around $21 pre-market. So once again, right at this lower pivot. Morgan Stanley's one that I talked about as a short out of this upper base to fill this gap. It filled that gap basically on that jobs report Friday before the bounce. Now it's back into that pivot, and it looks to me like it's headed for the 200-day moving average. Like Brittany said, these things are sort of priced for perfection, and all the reports have been solid. They haven't been perfect, and the banks are getting punished as a result of that.
And basically we should be at least prepared for perhaps an even bigger pullback in the banks overall.
I think so. I think so.
All right, time for some quick hits. Ready for the speed round?
I am.
All
Let's
right,
get into it.
Let's start with Apple. Bad day for the stock yesterday after negative news from suppliers Cirrus Logic. We've talked about that key 419 level, broke below that, and actually even broke below 400, closed at 398. So where's next support now? It's
the first time that Apple's been below $400 a share. It was briefly below it yesterday during the session since December 2011. So, obviously a huge down move. If 7 months ago somebody told you when Apple was above $700 a share that it would be below 400 by April, you would have called them crazy. But as we put together a blog post yesterday about there have been signs along the way, and then the knockout blow to break that pivot low of 419 was the pre-announcement from Cirrus Logic, CRUS is that symbol. CRUS closed the day down around 16%, and it was too much for Apple to hold. It finished down around 5%. But if we zoom out, the next major support level, we'll go to the weekly to look at that. It'll be a little easier. The next major support level is around the 380 area, as somebody has already drawn on here before. But Apple's not one. I think these pre-announcements and these earnings reports from suppliers is a huge red flag, and maybe an indication that Apple could be headed lower, despite the fact that it's lost more than 40% of its value from its peak.
Crazy. But it's not all bad out there. Nike held up well yesterday despite the markets being under pressure, gaining 0.6%. So that looks pretty good.
Yeah, we talked about that jobs report Friday again, and I was talking about in the morning call what are my favorite stocks and sectors on that gap down, and my #1 play that day was Nike. Because if you look at the chart of Nike, what we like to see after earnings and during earnings season is stocks that report good earnings, gap up, and either accelerate from those gaps or at least hold them. And you saw a nice upper level base from Nike. This is that day right here. The Nike, it didn't explode that day, but it held nicely in its upper level channel on that big gap down. And then on that Monday, it was able to break out of that base. So it's above all moving averages. Yesterday, it had a nice gain in the face of a weak market. And Nike, I think, is one that you can chase higher prices. And I don't think it's too extended. And I think this is one that could give you some upside.
Fantastic. And Salesforce.com announced its stock split yesterday. The split will go into effect today. Be interesting to see how the market reacts to it.
Yeah, I mean, I'm not going to go out there and say I expect it to rally huge or tank on the stock split, but I think it's something that traders will be watching as a result of that. Whenever you have a 4-for-1 stock split, it affects the stock generally in one way or the other. As you can see, the big. It's kind of hard to see on the daily chart here as they're adjusting for that 4-to-1 stock split, but just something to keep on your radar. CRM today, traders might be watching it because it could have some volatility due to that split.
And Yum Brands is still struggling from the sell-off in early April. It closed down 0.6% yesterday. I think it still has room to fall before its next support level.
Yeah, I mean, there's several stocks that I was looking at, taking a very stock-specific approach, ones that look like potential shorts. As we talk about this market potentially going into correction, I don't feel you have a ton of edge trading the indices, but if you look at select stocks, I think that's the way to go. Yum Brands made a lower high here, has a nice downtrend in place. Then it has also a bear flag looking pattern here. If it breaks lower out of this base, I think you could get some more downside in Yum Brands.
And we always talk about weak sectors like home builders and transports. And if we talk about the weakest of the week, we're looking at names like Lennar and UPS. Do we have more downside in store for these names despite them being so weak? Yeah,
a big part of our swing trading methodology is that you try to identify relatively weak sectors, and then within those sectors, you try to find the weakest stocks in those sectors, and those are the stocks that you should be looking to short. And Lennar is an example of that in the home builders. It's one of those red flag, faulty signal sectors we've been talking about. If we zoom out a little bit, you can get a better look at it, but you have an uptrend in place. We'll get our line tool out here for you guys. We'll draw this uptrend that Lennar looks to be in jeopardy of breaking. And like I said, home builders have been a weak sector. Lennar is one of the weakest ones in it and one of the ones that has the most bearish patterns. And you had sort of a breakout failure back here late March in Lennar. So I think you could see a break of that uptrend. The 200-day moving average would be the next place to watch. But once again, a weak stock in a weak sector, that's what you want to look to short.
So it looks like you could short UPS here too?
Same thing. Transports. We take a look at the chart of UPS. Transports have been weakening, potentially a sign that economic growth is slowing, which is, we're seeing that around the world, and it's starting to come to our shores. Economic growth slowing a lot, and then the Fed's activities have not been able to incrementally have as much impact as they used to have. But you have UPS also sort of in an upper level pattern that looks to have sort of a rounding top. You're sort of rounding off. You had a double high here, double top here, and then you have a lower high, and then you sort of have, with the line tool out, you sort of have an upper level channel here to base your short on. And it's another one that I think the 200-day moving average is going to be a popular destination for stocks if we do get a deeper correction, and then traders will judge the composure of the market after potentially we reach those levels.
All right, well, on another note, UNXL is a stock that's actually been able to make new highs while the market's been acting so erratic. The company announced a secondary offering after the close yesterday and actually traded lower by 7% to the 35 level afterwards. So $34 is the prior breakout level. Do you think you'll be able to hold it?
Yeah, I know this is a stock that the guys in the Momentum chat room, Mike Lee and Steve LeVay, have been trading very actively. And I think when you have a market that is looking like it could roll over a little bit, you want to, on a short-term basis, trade stocks that are volatile and sort of less correlated to the broader markets. And I think UNIPIXEL is one of those. Like you said, it looks to be lower after hours. The last print, if we look at the 5-minute chart here, is 34.10 in the after hours. So we'll go back to the daily chart. That's sort of a big move lower there. It's back to this breakout level just about. And I know that if you're in the Momentum chat room, you can also get a free trial on our website. This is something they'll definitely be watching, and I think there'll be volatility there. I don't know which direction it's going to be. I don't really trade the stock or watch it that closely, but definitely something to keep an eye on.
Well, we saw a similar situation happen with eBay yesterday that we've seen with the banks. eBay reported first quarter results that came in line with expectations. It did issue second quarter forecasts that were below expectations, and shares trade lower by more than 2% after hours. So similar case, we should be braced for lower prices here?
Yeah, if you know, eBay is just another example that I wanted to point out today of that this market seems to be priced for perfection. So you had a solid report from eBay. It met estimates, but it's still trading lower in the after hours. We look at the 5-minute chart here on the chart. 54.16 is the last print in the pre-market. You know, we go down here. It's below this upper level. It's going to close this gap that's from late March. And so it'll be right here around the 50-day moving average. So I think this is another one that traders will be watching closely intraday to see if we get some tradable volatility.
All right, finally, and United Health just saying that first quarter profit fell on lower government payments. What are the levels we should watch there today?
Yeah, I think UNH, the healthcare sector in general, you know, had a nice bounce from that ruling about the way Medicare payments are going to be made, and it has a nice upper level base. Take a look at the 5-minute, though, in United Health, and the healthcare sector could be weakening. So that could be another thing that takes the market lower, is that out of this upper level pattern, the healthcare stocks looked like they could provide more upside. But you know, there's always headline risk with pharmaceutical stocks and biotech stocks and healthcare stocks. And if these do weaken again, I think it could be another force that weighs in the market, potentially leads us lower.
All right. Well, with all of this erratic behavior out there and the volatility, what do you think we should focus on today?
Yeah, I mean, I think it's very difficult to stand up here and say the market's going lower when we're up more than 10% for the year and every sell-off seems to be bought. But that's what I'm telling you right now, and be calculated about it. You know, you always have stops in place if you're looking to short. Shorting in general is more difficult than buying, in my opinion. But I do think you can't ignore the faulty signals, and you can't ignore your process and your rules. And when you do see faulty signals and you see technical damage in not only stocks but huge corrections in commodities markets, it's a red flag that something is going on under the surface, and you should be a little bit more cautious at the very least.
All right, thanks so much. Happy trading, everybody. Have a great Thursday.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.